what actually worked for me is the lease option. I think it's a very easy concept to understand. It's easy to
Mhm.
grasp as an investor. It's easy to grasp as a seller.
Yes.
And then you have no money down, right?
Mhm.
You have a
Sure.
partner.
Hi, I'm George Pino, the CEO of Commercial Brokers International, and I have a great guest for you today, and thank you for joining in. You're going to be very pleasantly surprised and good information from Kevin Amolsch. He is the founder of Pine Financial Group, founder operator of Pine Financial Group, and more importantly, the author of 45-Day Investing, how to purchase your first investment property within 45 days with no money down. So, obviously, I'm gonna jump on that really quick, Kevin, because when someone says no money down, it's almost a too good to be true, and everyone hears this and what you can do and what happens. Now, I'm sure there are some caveats to that and how to go about it. But what has been your experience when let's say you're a first time investor? I know you bought your first home when you're 21.
Yep.
Um, you know, I think one of my biggest things I wish I had said was that my parents or someone told me to start buying real estate when I was,
Yeah.
and I didn't start investing in real estate till I was about 27. But younger than most people, but
Yep.
nowhere near where you're at. So, why don't you tell me a little bit about the experience, how you got there, but also then let's go into the zero down. How can somebody buy something with zero down?
Yeah, George, first of all, thank you so much for having me on. I know we talked a little bit before you hit record, and I'm just got to tell you, I'm really excited for the conversation today.
Yeah.
So I got started, as you said, when I was 21. I was getting out of the military at the time, and I bought my first house. I put a 3.5% down FHA,
Mhm.
very common, very by the book, 30-year fixed, and I rented it out to some roommates, and it was going great. Well, I wanted to buy another one because I was learning from all the books that I was reading, including the Purple Bible that we all know about, Rich Dad, Poor Dad. Everyone was saying you have to invest in real estate. That's how true wealth is created. So I was like, well, let's try this thing. So I went and bought another house. What I did was I used a student loan to buy my second property. I didn't need a student loan. I had the military paying for my school, but that was just a creative way for me to come up with a down payment that wasn't my money to buy my second home. I moved into the second home, kept the first one as a rental. So 23 years old, I had my first rental property, and I learned a lot through that process, including that I love the business. And so I started learning, how do I finance these? I don't have money. I have a keg of beer in my fridge. I don't have money to go out for down payments. So how do I do this? And I started learning about creative financing and owner carry and hard and private money and all these different tactics. And I just really fell in love with the financing side of real estate. That is the deal structure. So what I chased foreclosures for a while, but what actually worked for me is the lease option. I think it's a very easy concept to understand. It's easy to
Mhm.
grasp as an investor. It's easy to grasp as a seller. So it's a good entry point into real estate investing. And that's the path I took. And the 45-day investor book that you mentioned, that goes into a lot of detail on the lease option strategy, including where to find them, how to talk to the sellers, what scripts to use on the phone and in person, and all the forms that I was using to have the success I was having.
Right. Now, let me delve a little bit into that. How, because you always hear this, and I know within the brokerage community a lot, you hear, oh, I want to do a sale lease back, or I want to do a lease with an option to purchase.
Mhm.
And at least in the commercial real estate world, a lot of times the lease with the option to purchase, landlords are like, you know what? If I decide to sell, you'll be the first person I come to, but I'm not going to tie my rights up to you. How do you go about, and from what I understand, though, my experience has always been, these can be win-win situations. They just have to be explained
Mhm.
appropriately to the right party so that everyone understands what the goals and what you're trying to accomplish are. Now, are you seeing that also, like you were mentioning the lease back or lease with option to purchase for you? Um, and I know the book goes into it, but a little bit, maybe let's delve a little bit more into that and tell me a little bit, was it once you had the scripts and you found out, was it more of an education based thing, or is it more just a matter of numbers and targeting the right kind of areas where there's high vacancies or something like that?
Yeah, bingo, you hit it. I actually see it more in the commercial space than in residential. In the commercial world, you're dealing with a more sophisticated seller,
Yeah.
so the creative financing strategies typically work a little bit better because
Hmm.
the seller can grasp it. Homeowners that maybe are just had a job transfer and now they have double payments, they don't really understand some of the creative strategies because they're not in that business, right? So it is there's an educational component to it with the seller, trying to help them understand the benefits to you. It's important. The
Yeah.
benefits to them, of course, but also what's the benefit for me? If I could help them understand how I make my money and how this is going to benefit me as an investor, their guard comes down. And now all of a sudden, I just swung my chair around the table and we're sitting side by side. It's no longer we're going against each other. It's let's come together and come up with a solution for both of us. But I'll tell you, the lease option is a great strategy for sellers that have double payments because
Hmm.
it does eliminate one of the payments. And depending on how you structure it, it probably eliminates most or all of the maintenance that would go with the rental property.
Yeah.
So, yeah, you hit it on the head. You have to have the right target.
Hmm.
For me, the target that worked the best, I'll just kind of lift up the skirt here, George, and tell your listeners this is how you find the lease options if that's what you're into. It's stale listings. I had the most success with that. A stale listing is a listing that's been in the market on the MLS for a certain amount of time, 2, 3, 4 months, and it's still sitting there. So it's not yet expired, but it has been sitting there. Typically, that is an indication of little or no equity because if there was equity, they would be dropping the price. And if it's stale and not expired, now, only if you're not an agent, okay? But if you're not an agent, you can market to them. Hey, look, I want to buy your house. But if you're an agent, right, you have to wait for it to expire to market to them. So you're going to be in early before all of the agents start sending their mail. I want your listing. I want your listing. So you're getting in before them.
Sure. Makes sense. Now, I know that with a lease with option to purchase or even seller carry, there's definitely ways and benefits for the seller to do so as well as benefits for the purchaser.
Yeah.
On the with an option to purchase, one of the things that you had just mentioned to me was that how it has to be structured in a way, but are you utilizing that in a way such that you're using part of the rental payments for the down payment as well, so you're not coming in? So are you offering above market rents or figuring that out so that there's no lender involved or things or issues coming up? Also, one of the strategies I know that I've used before for seller carries is that, if the seller's not doing a 1031 exchange and they're just looking at cashing out, a structured payout over a course of 5 years on that loan that they carry for a certain small leverage can actually lower their capital gains payments by over 10%,
Yeah.
as long as they don't hit certain breakpoints. And by structuring it that way, they can do that if they don't need the capital right now. Now, is that something that you're going into in the far details, or are you leaving that up to the owner, saying, we can go this route and what's happening? How much of an education process do you see this needing? Is that the biggest hurdle to overcome?
Yeah, yes, it's the biggest hurdle to overcome. That would be an accurate statement. But look, what we're targeting here is motivation.
Hmm.
So we're talking about two different things here. We have the lease option where I'm not taking title. I'm only going to lease it with a right to buy at some point in the future. And I would write my lease options for maybe a 10-year term and I lock in my price at somewhere around today's value. So I'm paying full price for the house. I'm just not doing that until, sometime down the road. And then
Five,
I'm
six,
going to
7, 10 years with them.
yeah, sometime within the 10 years, I have the right to buy,
Sure.
not the obligation, right? It's an option to buy, not the obligation.
Sure.
And then I set a monthly payment. Now, ideally, depending on how good of a negotiator you are, you want that monthly payment to be below market. And you could use tools like, hey, what's a management company going to cost you? Oh, if I'm taking care of the maintenance, maybe we need to even lower that a little bit because a management company doesn't pay for any of the maintenance, right? So you could
Right.
use some tools to get that monthly payment down, and then you would lease it back out to somebody else. You just sublease. And a lot of times I would sublease with an option. So I do a lease option for my buy and a lease option for my sell. And that way I could virtually eliminate maintenance altogether because I'm passing the maintenance obligation on to my new tenant buyer.
Mhm.
Now that can get a little tricky to close when they're ready to exercise because you can't sell a house you don't own. So you have to be prepared to close on your option and then resell the property.
Mhm.
But over time, as the value of the house goes up, it becomes a very useful strategy. Now, when you were saying structured payout and owner carry, that's when you're actually taking title. So
Mhm.
the
Yes.
ownership of the house is transferring at the time of closing from the seller to you. And there's a whole lot of ways we could structure those types of deals, including the owner carry seconds, which could potentially eliminate any down payment requirements. Or, what we're seeing a lot of times is partner with owners. I'm starting to see more and more of that. Bring the
I,
partner in for equity,
I'm
and that
definitely
was
seeing that especially in the commercial side where they're coming
exactly.
in, they're bringing their property in as the equity side, have a developer come in for reposition the asset, or rehab it and then bring in better tenancies and then sell it at a later point at a higher price.
Yeah,
So
or
definitely
even if it's
seeing that
not
as
going to
well.
develop, if it's
Very
going to be,
much.
let's say it's a office building. I'm just
Yeah.
using that as an example because I think there's opportunities coming there. So the seller can say, hey, I'll stay in for 20%. My value is 2 million bucks. Let's say I want 1.8, 1.6, whatever the number is now. And then I'll leave my other 400,000 in as equity. We'll create
Mhm.
an LLC. I'll take 10 or 20%. You get 80, the buyer gets 80%. And then you go out and together and get a bank loan. Now, if you're under the 20% equity, they don't need to sign. There's no guarantee requirement from the bank, but the bank will count that equity as a part of the equity requirement for the closing.
Yeah.
And then you have no money down, right?
Mhm.
You have a partner.
Have a
You may or may
partner,
not want that, but
which that explains why hard money can be expensive. Speaking of
yes,
which, because partners do come with headaches. You're absolutely
yes,
right with that, and sometimes those headaches will outweigh the savings that you make. So that brings up another option of creative financing, which is hard money loans.
yep,
And I'll be the first person to admit that out of necessity, I had to use hard money loans when I was getting started. We were doing a lot of flips. We had at the time raising a family, getting married, all that fun stuff, life going on. And so, of course, there's a lot of draw on my cash
yeah.
requirements.
Money's
Uh,
finite.
exactly. But more importantly, also is also risk and, risk
Yep.
versus reward, because now I have to worry about if I mess up, I'm messing up for the family, not just myself. So when we started doing hard money loans, a lot of it was um, limited recourse and lower terms. And we knew that we were going to have to flip the property. So we're pretty conservative in our acquisition, our cost estimates. And generally speaking, I can tell you that we were, even though they were 6-month loan terms, we were almost out of every property within 3 to 4 months. That's from acquisition to rehab to selling it to closing the escrow. Very fast paced. And I hear over and over, hard money is only for people who can't afford properties, but I also have astute investors that use hard money quite often.
Yeah.
Can we delve a little bit into that? What your thoughts are on hard money?
Yeah, I'm so glad you bring that up, George, because hard money has a bad stigma to it
Yeah.
because it's a little bit more expensive, although it's not as expensive now with rates where they are. But it's got a bad stigma, and I think unnecessarily because, look, it's just a tool. Now, you're not going to pull out a hammer to drive in a screw, right? You're not going to pull out a screwdriver to hammer a nail
Mhm.
in. You have to have the right tool for the right situation. So it's good to understand hard money and its usefulness, and then you could decide when to use it. As you said, I have a lot of clients with over 700 credit scores, $500,000 in the bank. They're out there developing properties, doing fix and flips, and they come to me because it increases the volume they could do. It's a way for them to scale, right?
Mhm.
Because if you're putting less money into each deal, you could really spread your dollars further. So it's a good way to speed up the scalability of a company. And so it's not just for people or investors that are new. It's not just for investors with bad credit. It's a tool. It's a high leverage loan. So if you're looking for leverage, this is a great place to go. Now, like for us, we could finance potentially 100% of the project, purchase
Mhm.
and construction. So if you could finance 100%, even if it's more expensive debt is almost always cheaper than equity. So coming back to full circle, what we were just talking about with a partner, you can eliminate the need for bringing in partners into your deals just by paying a little bit more for your debt.
Absolutely.
So
Yep.
there is positive reasons to consider using hard money.
I agree with you 100%, Kevin. And it goes back to there's a couple old adages out there. Number one is that one thing that you had mentioned that it's too expensive. Something that was told me early on when I was working with a investor client, and they had just sold something that they were going to have to take a big hit on as far as capital gains tax. And he looked at it and they're like, well, if I exchange into this property, I'm only getting like a 4.25% return at the time. And we were talking about that, and he actually came back, and the investors looked at me and said, you know, I don't care if it's a 2 or 3% return because I'm 35% ahead of the game. Meaning that he is, the savings that he has on his capital gains and everything else, that it is he's already ahead of the game. He's not worried about that 2 or 3% differential in returns. Um, the other thing also is that when we were doing and using hard money loans, you're absolutely right. It allows you, the real estate industry is very cyclical. So, and typically when things are going up, they're all going up. And when things are going down, they're all going down. So if you can actually, so to speak, catch the wave of that cycle, it's the old adage of all boats rise in a rising tide.
Mhm.
And the best way to capitalize off that potentially is higher leverage or creative financing,
Yeah, totally.
because that allows you to scale up a lot quicker and then take advantage of those streams. Obviously, I would say if you're new to the investment game, meaning probably under 10 years and haven't really delved and seen a couple cycles, you might want to have an advisor help you.
Yes.
Because I've also seen a lot of people that were trying to catch that wave and the wave's already gone by,
Yep.
and they're, left standing when the tide goes out without any shorts on. And so that's the flip side of it. We see that all the time. I've even seen large companies that have jumped on and, they did very well during the upcycle, but all of a sudden they've never, no one that was in that company and the sponsors had ever gone through a down cycle, and they didn't know how to handle that. And they ended up losing all their properties going BK. Really vet out who your advisors are, who you're working with, and how you're going about is my recommendation. But I absolutely agree with you that hard money, it sounds like it might be more expensive, but just like you said, it's really a tool. And sometimes, if I'm having to pay 12%, but I'm going to have a 30% IRR on it, I'm okay with paying the 12%.
Yes. Exactly
It's
right.
fine. I don't care. Could I have waited and gotten a 6%? Potentially. But by using hard money, I may have been able to strike faster and get it done.
Well,
So,
George, I know that you're sensitive to risk. You've mentioned that several times.
yes.
And if you're going out there getting that 6% money, you're putting pretty significant down payments. And so you're taking cash out of your pocket and
Yep.
locking it up. It's locked into that project. You can't get that money back out unless you sell or refinance, right?
Mhm.
So if you could limit how much you outlay, you're shifting risk to the lender. You're keeping more money in your pocket, and that's what keeps you safe. Liquidity reserves, that's the one thing that'll keep you safe through any market. So
Mhm.
I'm a big proponent of high liquidity, high liquid reserves, and then
Yep.
that's going to create longevity in this business. So
I
maybe you
I
want to
agree.
keep, maybe you want to pay a little bit more for your money, but keep more cash in your pocket. So if there is a rainy day, you're prepared for it.
And the one thing I'm going to add to that, Kevin, is my whole mantra is in all my investments, at least my personal investments, and most of my actual syndications or sponsored investments that I do, has always been about cash flow. I don't like to play the appreciation game. I
That's
like to play
smart.
the cash flow because I can actually utilize trends, forecasts, actual analytical data to get pretty damn close to what I'm projecting. And on top of that, appreciation is now a bonus. So that's going to boost my IRRs that much more so if I end up selling.
Yeah, you won't take a loss if you don't have to sell, right? You
And
only will take a loss if you're forced to sell.
and in a down market, if it's cash flowing, I don't care if
Right.
it's down because I'm not selling at that point.
Right.
I have properties right now that, frankly, I paid more than what they're worth today. And I get calls every single day, practically, from other brokers around the country asking if I'm going to sell it. My response is always, I'm always happy to sell. I just don't think you're going to pay my price because I don't need to sell, and I'll sell it at what I paid for or higher, depending on the submarket and where it's going and my plans for the property. But every now and then I have somebody step up and they buy it, and I'm shocked, but
It's
that's
like,
okay.
okay, it's yours.
Uh, you know what? The funny part is, more often than not, I see that property back on the market about 6 months later,
Yeah, for less
um,
than they
for
paid for.
less or being foreclosed upon.
Yep.
It's making those wise decisions and projections are, I think, key to anything, even if the money's cheap or rather the risk is mitigated. You still need, you're investing for a reason. You're not just doing it to spend your time doing it. You're looking to make money. So that should be the key component of that. And realistically, where do all the tools in the creative financing fall so that you can utilize that to get it done as quickly as possible? So, I
It,
mean,
I was just
one,
going to say another way to reduce risk here is maybe you don't want to own the property at all.
yeah,
Maybe
I was going to ask
you're
you
a
that
little worried
a little bit.
about the
Mhm.
economy, the like whatever it is. You're a little concerned. Maybe you don't want to own a property and go for a ride down if that's a concern. There's always lending. You could lend to other investors that want to own and do exactly what I do and charge a high rate of return and get a low loan to value secured position in the real estate. And so you still have the real estate protecting your investment, but you're not going for the ride,
Mhm.
right? And private
Absolutely.
lending, I'll tell you what, George, it produces great cash flow, better than what you would get in a rental in most cases.
Yeah, I actually had a client that was primarily doing lending through a private lender. He was one of the investors coming in, giving the lender the money to lend,
Yeah, that's what we do.
and doing very well. Now we were able to, the one negative is you may not have the tax advantages as you do with the
Right.
real estate ownership.
No
Um,
1031s. That's right.
but we were able to structure something in a way that we actually were beating out his returns on that, just on the real estate side. But also, especially when taking into consideration, we started doing tax planning with the CPA and everything else. So I think there are definitely opportunities and places for that. I always tell everybody that, you want to diversify your risk when it comes to investing. And a good way to do that is to be on both sides of the table, the lender as well as the borrower, so to speak, in different instances. So it's definitely an option, and I think people should be looking at that.
Yeah.
They should be looking where it's at, and a good operator, someone who's been around a long time, such as yourself, is going to be able to have placements and a track record that they can show that, here's our typical IRR and hold period for our investments when it comes to the loan side, lending side.
Yep.
So, and that I think speaks more than anything else. And not so much perhaps in the last year or two, because debt's been crazy and everybody, you never know. It's like, again, those cycles. But go back and, really investigate those people a few years. And you're going to see that, the good people, they built their name and their reputation on that. And they're going to have a track record that's going to span 5, 10, 15, 20, 30 years, not just the last three. Um, so that's my 2 cents on the due diligence part. I hope that helps. But
Well, you
um,
mentioned that you were at the savings and loan crisis. You were in the business at that time. So we're talking about the 1980s now. And so you saw there was two crashes, two recessions in the 80s, and then there's the one in the 90s that
yep,
impacted real estate. Most recessions, you probably know this, George, but maybe the listener doesn't. Most recessions don't impact real estate. Okay, very few actually do. But the one in 1990 that's coming out of the savings and loan crisis did impact
yes,
real estate.
absolutely, and that's the main one. In the
Yep,
early '90s, I actually happened to be positioned well doing real estate auctions.
that's
Uh,
perfect. So I
and
wasn't investing at that time, but I studied
yep,
that recession because I wanted to learn from that. And then, of course, I was investing in the bubble burst, the dot-com bubble, and then also the credit crash in '08, obviously. So I've
wait,
been through it twice, and I've really dug deep into that 1990. So I feel like I have a grasp of going through the ups and the downs. But look, we have been on a run.
yeah, we
I'm not
have,
going to count COVID as a recession, even though officially it was.
yeah,
We've been on a run since 2008.
yeah,
Right. So
I agree.
we haven't really seen anyone who started in the business after that hasn't really seen or haven't really felt what that is.
Yeah, you mean the lending side? I'm assuming.
Either side. I
Well,
mean,
I know
we
some of
haven't
the.
really seen a recession. I mean, right
Well, no, no,
now,
no. But I mean, the real estate investing side, I know that there's been a lot of issues when it comes to either the refinancing, especially with some of the
Oh yeah, yeah.
certain asset classes like the office buildings and things like that, that it's
Oh yeah.
definitely been impacted a little bit. I also see that, what was an interesting stat for me was, 47% of commercial real estate agents made zero money last year.
That's sad.
47%.
But that's skewed because a lot of them aren't trying.
A lot of them are trying, a lot of them are maybe just hanging their license and things like that. But even the average income of the active people that are in there, it's amazing what has changed just in the last few years. Now, we have seen it loosen up quite a bit in the last 6 months, and a lot of that is just consumer perception.
Yeah, exactly right.
Nothing else has really changed. It's really more about perceptions going into election year, what's happening, the fact that the Fed's reduced rates just recently to like 50 basis points. But the fact is, in commercial real estate, we don't see that because we're not tied to that index, so to speak.
Right.
We're typically tied to a 10-year treasury, which is less volatile. Um, so you're right, where we're not seeing those spikes and dips and things like that. And we have definitely been riding a heck of a way from I disagree from 2008 because I think 2009-ish is probably when things started coming back a little bit more.
Okay. Yeah, you're
Nine,
actually, yeah,
10.
it's 8 to 10 was pretty rough. So yeah,
I
you're right.
know that because in 2008, right in October, a week before the stock market crashed, I took out a property for syndication that was 300 units in Texas. And in the first 2 days, we sold out 90% of the spots, and then the stock market crashed. Took us another 3 months to sell out the rest of the 10% of the remaining spots, and but we did. We ended up closing on the deal and moving forward on it. It was an act rehab deal, but it was definitely a tough, tough time, and we
Oh
saw a lot of
gosh.
stuff going on.
I still remember when Lehman bankruptcy. I was, oh gosh, this is
Oh,
real. This
yeah,
is
that
real. Yeah.
even, I mean, in the 90s was interesting because I was all, for the most part, I've been in Los Angeles, and we also had the double, we had the Northridge earthquake, which compounded a lot of the real estate issues because of the damage and not being covered. Most homes don't have earthquake insurance, just like most homes don't have hurricane insurance in hurricane areas.
Mhm.
But between that, and even the Rodney Pete, or not Rodney Pete, but the riots that came about, that all impacted California and Southern California specifically, and kind of had a dual course where I think we actually were a little bit probably in a rougher patch than most of the country for about a year extra. But it was an interesting market, and I got to tell you, I learned more about real estate in those years than I have in the last 10 good years.
Oh yeah.
So and I think those are things that you want to look for partners. You want people that can add value and help you navigate the rough times, not just hold your hands and skip down the flower path.
That's exactly right.
So
It's easy to make money when everyone's making money.
yeah,
It's tough to
absolutely.
you gotta stay afloat when everyone's not making money. That's what separates you.
Exactly. And a lot of that is just going back and doing the right due diligence ahead of time, making sure that you have the right debt in place so that you're not caught and you're like for my debt planning, and tell me if this is a wrong way to go about it because I'm the first to admit I don't know I don't know everything. Okay. And I'm always happy to learn. I'm also one of the first persons to admit that I'm almost learning something new every single day.
Me too.
And when it comes to the debt markets, I think one of the biggest mistakes a lot of people make is they're looking at short term versus what's their actual hold strategy. Are they going medium, long, short? What are they doing at? For instance, I had a client that I know, they ended up going in and saying, "Oh, no, no, I'm not going to get an arm. I'm not going to get an arm. It's too risky." I said, "Well, how long are you planning on holding the property for?" 3 years. Okay. That arm, it's fixed for 5. Yeah, but what happens
Yeah.
if I don't can't sell it in 5 years? Well, it doesn't jump automatically. Had to explain it and saying you're saving a lot more money going with the arm, even if you hold the property for 7 years.
Well, let me
Just
give you an example of this exact point. I
yeah.
just bought an office building, okay, about 24,000 feet. And a credit union offered me a loan about a half a point higher than I can get it from, even my own bank. But there's no prepayment penalty. Now the bank, and in fact, several banks all wanted to do the deal at, a certain interest rate, which was half a point less than the
Mhm.
credit union, but they all had like 3-3, a 3-3-3
Yeah,
prepayment, all these different, they're very creative with these prepayment penalties, but they all had like a little burnout and it's all 3 to 5 years. Well, I happen to believe that interest rates are coming down over the next couple of years, and I want to be in a position that I could refinance. So
yep,
my strategy is to play the long game and get ready to get into my permanent loan in the next 2 to 3 years. So I would rather pay a little higher interest rate now to not have that prepayment
absolutely.
penalty.
Absolutely. That's why I always say that when you're looking at the property, don't just look for the today. What's your plan of action? What's your hold period? What are you anticipating? It's very wise for you to go that route, and think of it that way. Um, Same with prepayment penalties. A lot of those prepayment penalties, if you look at it, they allow you to prepay up to 20%, a year without penalty.
Yeah, that's true.
So if you do that, you can potentially burn it off as well in that 5 year period as well. But it's a little bit more structured. It does take some of your cash. It's going to tie it up for the period of time, things like that.
Was
But
your
it can be
goal to
worth
pay off the building or is your goal to get into a good
exactly,
leverage long-term debt?
exactly. So in which case, then let's run the numbers. Which is going to be best for you,
Yeah,
and that's why I advise all my clients. And find more importantly, find a lender that can advise you, that's going to first of all ask you these questions, because if your lender doesn't know what you're trying to accomplish, they're probably just going to sell you the best loan for them,
for them, yes.
not for you. And so find a lender that actually cares about your investment criteria. Find one that you're looking to, that's going to ask you the questions about how you're investing, what you're looking to do. Are you looking to flip? Do you need to maybe roll in some capital expenses that you want to add to the building? And can they do
Yep,
that?
yep.
All kinds of things that can help you with that. But they should be asking you these questions as well, so that they can give you the best loan that's structured.
Yeah, 100% agree.
Great.
And
So,
back to your point, good
yeah,
advisors.
exactly. Advisors more than just paper pushers.
Yeah, exactly.
So, all right. Well, no, I think this is really good. And I think we just scratched the surface, especially when it came to creative financing. So, what I'm going to do is I'm going to put your contact information down below here, as well as a link to your book, the 45-Day Investor. And should anyone have any questions, please do reach out to Kevin. He can be a wealth of knowledge on the debt side, investing side, all of that for you. So, again, thank you so much for joining me, Kevin.
Yeah, and George, real quick for the
Yep.
listener, if you are interested in that savings and loans problem and then the 14% decline in property values in the early 90s, and you want to try to learn from that, I did deep dive into that and write a report. So I'm giving that report away for free at thepinereport.com. There's
Nice.
actually a second report on there if you want to be a private lender. Whether you work with us or anybody else, just stay safe because people will lose money in that business, even as safe as it is. You have to do it right. So I'm
Yep.
trying to help people do it right so they don't lose. I get
Mhm.
calls all the time, George. People get themselves into a mess and they ask me to help them. Well, sometimes you can't unwrap a decision you've made or
Mhm.
unravel it. So I'd rather you just not make that mistake. So thepinereport.com.
Yep, I agree with you absolutely that the best way to avoid mistakes and problems is to actually investigate it before you jump into it.
Learn from my mistakes. How
Yeah,
about
you're not gonna,
that?
you're not gonna break your legs jumping into an empty pool if you look to make sure there's water. So
All
um,
right. I
thanks
really
again,
appreciate the
Kevin, for
time,
joining us,
George.
and also thank you for joining us and watching this video. If for some reason you haven't done so yet, please give me a like and subscribe, and we'll make sure that you're on the list for the next one coming out.